Well, the Nifty has officially, or rather arithmetically, entered correction terrain. It is now over 10%, 10.1% down from its all-time high hit in September of 26,277. The stark reasons are clearly global and are for all to see. Dollar index over 109, the US 10-year yield is pretty close to 4.7, 4.68 today, and Donald Trump hasn't even been sworn in yet. So how do we navigate the next few months and even all of 2025? I have with me Anish Tawakley, Fund Manager, Equities at ICICI Prudential Fund. His blue chip fund has returned 27% in the past year and 15.5% since inception, while his manufacturing fund has returned over 35% in the past year and 22% since inception. Anish, good morning, and thank you very much indeed for dropping into our studio.
Morning, Latha. Pleasure being here.
Well, we have seen this Trump trade already getting played out. Do you think that we will see worse? 4.7 on the US 10-year and 109 on dollar. What should we be prepared for?
So the interesting thing is the trade is playing out differently in the US equity markets and in the bond markets, right? That's the stark contrast. The US equity markets have done very well, but bond yields have gone up. And I think the bond yields, bond markets are right to be worried because if you look at the US economy right now, unemployment is very low, yes, which tells you that the economy is already operating at full capacity. Yes. So at this point in time, right, the right fiscal strategy would be to raise taxes, not cut taxes, right? So fiscal deficit is high, starting bond debt levels are high. And if you're going to cut taxes in a booming economy, the bond markets are right to be worried.
Yeah, you will get inflation.
Yeah, you will get inflation and will be priced in by the bond markets, or the Fed will have to step in and say we can't cut rates, we might even have to hike rates. And I think the Fed has already expressed concerns about the fiscal
the minutes
stance.
said that.
Minutes said that, right? So I think how the equity markets react to the bond yields rising is something that we need to see. I would expect at some point the equity markets will take note of that. Okay. Having said that, it's not that much of a risk for the Indian economy, right? I'm distinguishing between the economy and the markets because there is a divergence that can persist for a while.
Yes, that's very important, of course, that Indian financial markets may have an issue with dollars going away, but the economy is in a different piece. Yeah. But let me just finish the the US argument a bit and then come to the Indian earnings story as well. Do you therefore think that we can be in for further rallies in the dollar and increases in yields? Or do you think most is priced in? I mean, people are pretty scared about Jan 20th and thereafter. But you think that this trade can go on?
No, I would be of the view that the dollar has probably peaked, right? I don't think, I mean, if bond yields are rising because markets are worried about the sustainability of the fiscal deficit, that's not an environment where the dollar should appreciate, right? Okay. And that's another disconnect between the currency markets and the bond markets, right? Okay. See, if interest rates are going up because your economy is strong, it's normal for your currency to appreciate, but that's not what's happening here, right? The economy was already strong. The interest rates, the bond yields are not moving up because the economy is strong. Bond yields are moving up because the markets are worried about your ability to finance your deficits. Yes. That's not an environment where I would expect the dollar to appreciate further.
And the equity markets to continue with this kind of exuberance. Yeah, I mean, that is the big worry. So you're in the camp which believes that a lot of the bad news is, or a lot of the Trump trade is probably priced in. You know, we get both these views. Yeah. Some saying that, you know, he can still drive things further. Whatever, 110 on the dollar. There was one person speaking of 112 as well. But many of them saying that, you know, it can't get worse than this. Yeah. But, you know, to come back to India, do you think that the earnings story is under threat? Because we saw the second quarter see a lot of earnings revision. And the biggest blow, of course, was GDP coming in at 5.4. Now, do you think that earnings tension is behind us?
So let me distinguish between the current sort of soft patch in the economy and a little bit of the outlook, right? I don't think there's any fundamental problem with the economy. I do think the economy can regain momentum. There is no specific imbalance that threatens the outlook for the economy. And if it doesn't pick up on its own, there is room for monetary support clearly, right? So we are not taking the view that the economic slowdown should persist. We do think the economy should regain momentum. Okay. And earnings should therefore, which does not mean this quarter will be good, but we do expect that earnings momentum rebuilds, particularly if we get support, monetary support from the
Okay.
from the central
So do you see earnings growth at around 15% coming back in FY26 itself? Or
So
I'm looking at Nifty EPS, of course, your own set of stocks could be different.
see, a little bit, I mean, it could be, I mean, it could be, it should be in that range, yeah.
Okay, so now let's come to sectors. Where would you place your bets? Do you get, everybody who comes here are speaking that we prefer large cap over small cap. Everyone prefers banks because they have been the dog stocks, in the year gone by. Bank Nifty didn't give hardly 4%, whereas at least Nifty returned 10%. So where would your preference be?
So clearly, we have been amongst the first to say that small cap is an area of concern, and that continues to be the case. The fact that there are so many promoters diluting, etc., tells us that reinforces our view that that segment is does not offer a good risk return trade-off. Now, if you look at sectorally, if you believe as we do that the economy will regain momentum, then we would be in the domestic cyclical space, right? I mean, which means stuff like cement, automobiles, capital goods, and also banks. Although there I would be careful amongst, I do think that...
Which banks?
I would go with the larger banks, and I would be careful of unsecured lending exposures in general, right? We are fairly cautious on that.
Okay.
So in the lending space, we are very cautious on the unsecured lending space.
Okay. So would you therefore prefer insurance then?
Insurance we have, and if you look at our business cycle fund, we are overweight insurance. That has been impacted a little bit by the regulatory uncertainties, but I think the outlook for the sector is, for demand is good.
Yeah. For the industry itself cannot be questioned. Yeah. Okay. Now, what about consumption? Because we did see a big dip in consumption in the second quarter, and the GDP numbers also showed, but the advanced GDP numbers are showing an improvement in consumption. Is it staples or is it consumer discretionaries? Gold companies, hotel companies, airline companies. Which side? Which part of the K, if you please?
So actually, my issue with FMCG companies, right, is not that the economy is weak. See, the FMCG companies are reporting 0 to 2% growth.
Yes.
Right?
Some of them, yeah.
Now, reality is, even if the GDP went up from 5.5 to 7.5, it's not as it's not that there's 0 to 2 is going to go to 7.
Yes.
Right? So I don't think the problem with the FMCG companies is the macroeconomy.
Okay.
The problem, in my view, with the FMCG companies is they are over-earning. I think their margins are too high, and therefore they have
to come to terms with the reality.
They have to come to terms with the reality. So I think there need to be earnings downgrades in the FMCG sector as these companies take some margin correction, invest more in the business.
Okay.
They're good companies.
Yes.
This is exactly what happened if you go back to the early 2000s. The same thing had happened. Margins were very high.
Yes.
Volume growth had collapsed. And it took some time before these companies finally accepted that, look, we will...
Corrected their business strategy.
So I don't ascribe the FMCG sector's challenges to the macroeconomic situation. Okay. I think it's more internal.
Yeah. But what about discretionaries? You still would be very...
So discretionary should pick up if the economy regains momentum.
Okay. Right? So your top sectors would be construction, cement?
Cement, capital goods, and automobiles.
Okay. You're not very positive on IT?
So IT, I think the dollar strength is done. And look, I mean, what I've been wondering with the IT narrative is that the US economy is already strong, right? It's not as the US economy is weak.
Yes.
So I'm wondering...
So how much more can you get?
How many more can you get? And also, I mean, how much of the Indian IT sector, right, is not just the Indian listed companies. The captives are also part of the Indian IT sector.
GCCs.
GCCs are part of the Indian IT sector. So it's not as the Indian IT sector overall has been doing badly. The GCCs are growing
Probably
really,
the listed are losing out.
I don't know what's happening, but that could be one of the possible explanations.
Okay. Right? No, fair point.
So I don't want to bet on a big improvement in the Indian IT trajectory based on any...
Given the fact that you think that the US economy is already strong. Yeah. What about, more generally the return that you're expecting? Should we be prepared for lower returns in 2025? Or last year, in spite of the correction, we got 10% at least.
So the last few returns have been phenomenal, right? And typically when that happens, you have front-loaded some of the returns.
Some of this year's gains.
So you should be prepared for a little more moderate expectations going forward. But I'd never advise people to enter equities for a 1-year view, right? You have to take, in my view, at least a 3-year view. Okay. And if over a 3-year period, the economy does well, which is what we would expect, returns in the large cap space should be healthy. I would still worry about small and mid.
Do you think this is the time, or would you advise, of course you are the equity fund manager, but is it better to be in multi-asset at this point in time?
That is our view. I mean, we do think like asset allocation products are good at this point in time because you leave the decision to
the fund manager, someone who knows better, yes.
Who does that for a living. Yeah.
Okay, so I mean, considering that gold also gave very good returns last year. So where do you see the red flags? Which would be your avoid sectors?
So the avoid sectors, I would still say FMCG is a clear avoid for me. I'm also fairly concerned about metals, particularly ferrous. Because I don't think China demand is coming back. And China demand is half of the global demand.
Yes.
So if that half is shrinking, no matter whatever mathematical gymnastics you do with the rest of the demand, you don't get growth.
You don't get that kind of demand.
Yeah. And so if overall demand for metals is under pressure or negative, I'm fairly cautious on metals. IT, as I said, right, it's not that exciting for me, particularly after the dollar move up. Okay. So those would be the 3 that I would avoid. And consumer unsecured lending is a clear avoid for us. And it has been for a while.
Oh, yes, of course, of course. What are the red flags you see? Do you think there can be some financial accident because of the kind of geopolitics we are handling in? We are kind of staring at. I mean, one day Greenland, one day Gulf of Mexico should be Gulf of America, things like that. Is there chances of an overview?
If you look at it from a purely mathematically, right? Any country where the bond yields, the long-term bond yields, start exceeding the nominal growth rate of the economy is a fairly risky situation. And if you look at the US bond yield, it's 4.7 now. You look at the Fed's forecast for nominal GDP growth rate, it's 4.6 this year, 4.1 next year, right? So now, and I mean, US population doesn't grow that fast. Productivity, they're already at peak performance.
No, I take your point that
I think the US bond yields are clearly a source of
worry for the financial markets,
at least. And but having said that, in India, given that we have a solid foreign exchange reserve base, we can buffer ourselves from external volatility should that arise.
Okay, I'm being warned that I've exceeded my time. Very quickly, until now, when the FIIs moved out, you had the domestic money coming in. Are you confident that that stream will remain?
I never make any assumptions about flows. Okay, there is no good model for forecasting flows, and essentially, when you're betting on flows, you're betting on the greater fool theory. It's not a sensible investment strategy.
That's the best fund manager I can think of, someone who believes in earnings and not in flows.
I would not want to, I don't even spend any time trying to forecast flows. Zero.
This is absolutely the best advice you're giving us. Thank you very much, Anish Tawakley, for joining us. It's an excellent conversation we have had, wrapping up on Bazaar. On that note, Chartbusters coming up.